all, welcome and thank you for joining today's PENTalk. I'm Beth Parker with Pentegra. Before we begin, I just want to go over a few housekeeping items. First, please find the control panel that's located on your screen. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many as we can. Tomorrow, you'll receive an email with a link to replay today's broadcast. Additionally, in the handout section of the control panel, I've loaded in a copy of today's slide deck. You may download that now or at any point during the presentation. Let's get started. Joining us today is Rich Rouser, Senior Vice President of Thought Leadership at Pentegra. Rich has more than 30 years of experience in the retirement benefits industry and is responsible for helping to shape and define Pentegra's viewpoint on workplace retirement plans, plan design strategy, retirement success, and employee savings trends. Rich, thanks as always for hosting. Let's talk about these bills that Congress is currently reviewing.
Great, Beth. Thanks for teeing it up today. Thanks, everybody, for attending. We have a relatively short pen talk today. I think we always schedule it for about 30 minutes, so we will definitely conclude on time. But we've got some interesting things to talk about today. And there are three bills in particular that we're going to talk about and get into some of the details of what I think the final version of this stuff will look like, and I'll give you some predictions, hopefully in terms of what we're going to end up with, and maybe some of the timing on this too. Of course, there will obviously be open questions on that. So, first one that we're going to talk about is HR 2954. I call it SSRA, or Secure 2.0 is another way to talk about this one, Securing a Strong Retirement Act. This was passed by the House back in March of this year. This was actually introduced a long time ago, as early as I think it was May of 2021. And this actually got us really excited last year. And I remember making a couple of predictions that I actually thought this was going to be passed into law, at the 11th hour in 2021. Well, of course, that didn't happen, but there's been a heck of a lot of progress since. So you can see that there was huge bipartisan support for this. The vote was 414 to 5 in favor, and there were about 51 retirement plan provisions there, and pretty much everything in that bill was kind of under what I call good stuff. And what I mean by that good stuff from a participant standpoint, good stuff from a plan sponsor standpoint, good stuff in terms of new adopting employers. And again, a big part of this bill, is to promote retirement security, to increase retirement savings, to make it easier, better, again, at both the participant and the plan sponsor level. And there are also increased incentives in there for new plan formation. And again, that is and has been a big initiative of the current administration as well as the prior administration, which is to increase retirement plan coverage in the United States. That really is the underlying theme of all of this. So that's that one. Then there's a Senate bill, and this is really good news. This is the Retirement Improvement and Savings Enhancement to Supplement Healthy Investments for the Nest Egg Act. Boy, that's a mouthful, right? We call it the Rise and Shine Act, Senate 4353. And again, this has a lot of provisions, many of them identical to what's in Secure 2.0 or SSRA, some of them similar but a little bit different. I'm not necessarily going to get into all that minutia today, but for example, some of the credits for new plan formation might be a little bit less under this version of this bill than they were under the House bill. But again, a lot of provisions here to promote retirement savings, retirement security, and in particular new plan formation. So, the good news is this is being considered by the full Senate at this point. The Senate committee on this unanimously approved it back in June. So that really is good news, because typically, in terms of any legislative efforts, typically there's one version of a bill that starts in the House in this case, a second bill introduced into the Senate, and this bill actually has roots, I think, back to maybe late 2021, which is one of the reasons we were thinking initially that we might see all of this combined legislation pass last year. So, but this was, came out of committee in June. Full Senate's now looking at it. Ultimately, what we're hoping is that there'll be some reconciliation of the bills, and eventually they'll be agreed upon in somewhat different format from either one of them right now, right? There's always negotiation on these things, and we'll hopefully get something in a consolidated piece that would eventually be approved by Congress and then go to the president's desk. The third bill that we'll talk about is the Enhancing American Retirement Now Act, otherwise known as EARN. This was approved by the Senate Finance Committee. This has 70 retirement plan provisions, and again, now being considered by the full Senate. So a lot of this, again, dovetails with each other. A lot of these bills, provisions in the bills, speak to the same exact points. And again, there are some differences which we're going to go through today. So let's start with some of the differences. Again, the Rise and Shine Act has some similarities with the other. It says balls, but it should be bills. That's fine. Biggest difference, you're going to go through some of these, is it does not include the mandatory auto enrollment provision for certain businesses with more than 10 employees, right? So it's a little bit of a difference. Instead of that, though, it includes an automatic re-enrollment provision every 3 years. So what that means is essentially, every 3 years down the road, there'd be the ability, or maybe the mandate, I should say, of the plan sponsors to, re-enroll participants who, for whatever reason, are not participating in their, employer's 401k type plan, to, defined contribution plan. The Rise and Shine Act also has provision for emergency savings that would be linked to defined contribution plans. And this has kind of been bantered about in various forms over the last couple of years. This provision is not in Secure 2.0 SSRA, right? And, the various forms have been, well, maybe there should be a different in-service distribution provision for certain emergencies with a cap, things of that nature. But again, it's in the Senate version of the bill, not the House version of the bill at this point. Some of the other provisions in the Rise and Shine that Secure 2.0 does not provide for, it would allow for certain expenses to be paid from plan assets. And I'm going to cover some of those details in a couple of more minutes here. There is a call to consolidate one of the pain points of defined contribution plan sponsors, which is the various notices that go out. And again, I've got some detail coming up on that, but there's been a lot of controversy, number one, over the complexity of these notices and how they are written in, using prescribed language from IRS and DOL, and also the timing. Some of these notices are then required to be sent separate from other notices, which really increases burdens on plan sponsors, number one, in terms of timing, and number two, in terms of the cost and expense to do multiple either mailings or emails or whoever those notices are disclosed to, provided to participants. And there's a third bullet I've got here. It applies to defined contribution group type plans, or they were originally in the Secure Act. The original Secure Act passed in December of 2019, provided for a group of plans concept. Again, I won't go into a ton of detail on that right now, but In many ways, they are similar to multiple employer plans, but by the same token, they are different. So there's some recognition of that, and there's some hopefully fine-tuning of the audit requirements there. So, and I just put up on the screen some things that are in Secure 2.0 or SSRA that the Rise and Shine Act doesn't have. It increases tax credits for small employer formation, for any plan sponsor that's deemed to be a small employer. There are tax credits to offset startup costs. So it's really incentives to drive formation of new retirement plans across the country. There's also an increase in participant in the tax saver credit. That's basically tax credits that certain individual participants can get if they earn below a certain income level. And this also increases participant catch-up provisions, kind of phased up over time. The fourth bullet I have here has been kicking around for a couple of years, and this would treat student loan payments as elective deferrals, in the context of an employer being able to make a matching contribution. This goes back a number of years at this point. I think it was Abbott Labs applied to the IRS for a private letter ruling, where they, kind of made the case that, they had a lot of employees with student debt who were so busy paying back their student debt that arguably they couldn't afford to contribute to the 401k plan, and because they couldn't afford to contribute to the plan, they were not able to obviously get a matching contribution. So this bill essentially would say, look, if an employee is confirmed to be repaying a student loan, you could assume that is akin to a deferral on a 401k, and you can actually calculate a matching contribution that would go into the 401k plan on their behalf. I've done it in a prior webinar. I'm not going to do it today, but there are complexities with, how does an employer actually track which participants have student loans, and how do they confirm the loan repayment, so on and so forth. So there's a little bit of messiness there, but nonetheless, it is recognizing that certain people can't necessarily afford to contribute to the plan. It cleans up, you can see the second to last bullet here, the required minimum distribution issues for life annuities. Again, a little bit of a complex subject, but the bottom line is, if I'm taking a life annuity via an in-plan annuity solution, it's possible that that is not complying with RMD, required distributions once they hit age 72. You'll recall that RMD age was pushed up. So this kind of cleans that up a bit, or a lot, I should say. And the last bullet is, I think, kind of important. It establishes a retirement savings lost and found database. Now, for those of you familiar with defined benefit plans, right, the PBGC actually Pension Benefit Guaranty Corp, that is, actually has, I wouldn't call it a lost and found, but actually has mechanisms where it can kind of track participant benefits in prior defined benefit plans. And this is, a similar issue, though, right, on the DC side with, I forget what the stat is on how many different jobs an employee could have over their working career, but let's say upwards of 10 different jobs. And if they have a piece of their 401k benefits left behind at various employers, it'd be kind of a way for a participant to figure out where that money is, or recall where the money is, and maybe decide to consolidate it, so on and so forth. But also, for small balances, there are forced cash out provisions in the law that many employers take advantage of, that cash out those small balances and force them out into a kind of a rollover IRA that participant, may not really even have a clue that the money is out there somewhere. So it's kind of been out there for a while. It's been an issue for a while. And it's something that, it's about time that we try to get a database established to kind of record that stuff. The SSRA has a bunch of revenue increases that are not contained in the Rise and Shine Act. Now, before I go much further here, let me just speak about that, right? The Secure 2.0, the Rise and Shine Act, I mean, all of these provisions are essentially favorable to participants and plan sponsors. And what I mean by favorable is it encourages more retirement savings. It, in a lot of cases, and we'll go through some of the provisions today, increases the amount that participants can save. And the problem is that costs the government money, right? To the extent that anybody makes a salary deferral on a pre-tax basis, likewise, any matching contribution the employer makes in the plan is tax deductible. So any pre-tax money or match contribution that is not subject to tax currently means that the government is getting less money today. And all of these provisions and buried in these various pieces of legislation, again, expand the ability of participants to save money, which is going to cost the government money in the near term. So that is kind of problem number one. And the question is, how do they solve that? So revenue enhancing provisions, I'm going to hopefully get to a few of those a little bit later, are there to try to make up for some of that shortfall. And again, I'll remind everybody, in the original Secure Act in 2019, one of the biggest things there that helped, in theory, help pay for that great legislation was increased fines and penalties for plan defects, right? Where, if there's an audit issue and a plan is audited and defects are found, many of the standard penalties were increased by a factor of 10, meaning things that were a $25 a day penalty are now $250 a day. And the caps that were on them also went up literally by a factor of 10. So again, revenue increases it's probably some of what they're trying to figure out here. So again, the legislation is going to change, right, as it kind of goes through the process here. Right now, I think all of this has higher hopes this year of somehow passing into law. I would hope over the next couple of months is literally what I think, but more on that a little bit later. So Senate Finance Committee just definitionally has jurisdiction over the Internal Revenue Code. There's a Senate Health Committee that works on various retirement issues. So all of this stuff, let me see if I can get this to flip another page, is in process. Okay, so some of the other things unique to the Secure 2.0 or SSRA requires automatic enrollment provisions in all new 401k and 403b plans. So right now that's done. That auto enrollment is on a voluntary basis. A lot of plan sponsors have adopted that over the last couple of years, but it would require new plans to have that. I'm not going to touch much on the next bullet I put up, but there is some flexibility, as you can see, in determining when certain securities are considered publicly traded for diversification purposes. There would be, under SSRA, again, a one-time paper notice to participants who are otherwise subject to the electronic disclosure rules, and it would also require one paper benefit statement annually. And again, that's a little bit of a thing in the industry that is kind of a sore point. It's like, well, if you go into electronic delivery and if you're complying with all the rules that are laid out for that, the mandate to still have to do a paper statement is counterproductive, if you will, and it creates, in my view, just a less efficient environment. Again, unique to Rise and Shine, auto re-enrollment for anybody who opted out. I mentioned that earlier. There's a couple of defined benefit provisions here in Rise and Shine. I'm not going to get into those today. I think most of the people, most on this webinar, probably focus more on the defined contribution elements here. So if you want to talk further about DB plan provisions, I'm happy to do that at a later date. The bottom bullet here I just put up, Rise and Shine has the ability for certain expenses to be paid out of the plan. So in the past, well, I shouldn't say in the past, currently, there are certain things, certain work efforts, if you were, that go into a plan that are not permitted to be paid by plan assets. So they're putting in a couple of provisions here that, if there's a fee, let's say, to do an amendment or something of that nature, that those could be paid by the plan rather than being paid by the employer. Again, these are designed, features are designed to increase retirement plan coverage. And the problem they've identified is, gee, if an employer has to pay out of pocket for some of this stuff, they may not want to do it. So it's there to provide flexibility to plan sponsors to encourage them to make some of these changes. There's provisions for certain changes to automatic safe harbor designs, right? With higher contributions than what's under current law. Penalty-free withdrawals for long-term care contract, it would be available if the provisions of the EARN Act end up being incorporated into the other couple of bills that are kicking around. There's also penalty-free disaster relief for certain withdrawals, right? And such that they could be redeposited, essentially paid back to the plan. I think many of you will recall with the CARES Act, right? That put in, that was, when was that? May? I think that was May of 20, my gosh, I can't remember, May of 2020 at this point, the beginning of the pandemic, right? Where the CARES Act said you could allow plan loans to certain participants who were impacted by COVID, and or make certain in-service distributions available. And the problem with the in-service, well, put it this way, the problem with certain withdrawals is you can't necessarily redeposit them to the plan. Let's leave it at that. So this would provide for more flexibility to participants. And the whole notion behind that is, once you take a withdrawal or a distribution, in the past, under the hardship rules, you really can't pay that money back, right? So this is kind of expanding, I think, some of the repayment provisions that were in the CARES Act on some of those distributions, which would be beneficial, right, to participants, certainly beneficial to those participants who could afford to do that. This last bullet is interesting. I don't know, I haven't yet really figured out how that would really work, but auto rollovers of a participant's default IRA that was, kind of a result of a distribution from a prior employer's plan. This is kind of saying there should be an ability to reconnect that money with the participant's new plan. So again, that would be easier to accomplish if there was that, retirement plan distribution database, lost and found that I mentioned earlier. If they start to track those distributions from those prior plans and those forced cash outs, certainly at that point it would be easier to reconnect the money to an employee's current plan. But right now, without that, I'm not really sure how that would be effective. So that's probably one of the items that between the House and the Senate that they would reconcile and kind of figure out. And by the way, this is in the EARN Act, right, that I mentioned. So whether or not any of this gets wrapped to the other two, we don't even know yet, but it certainly would be an improvement and certainly would be beneficial to those participants. And then there's some standardization in this bill on direct rollover forms that would help things a lot. The other thing, and this would be, I highlighted this one at the bottom in blue, right? 401k designated Roth accounts would not be subject to required minimum distributions. The Roth 401k feature has been adopted by a lot of employers, and the benefits of that to the participant are that they're not subject to the income limitations of regular Roth IRAs, right? If you, as an individual, wanted to do a Roth IRA, you might not actually be able to do it if your income is above a certain threshold, or the amount you can contribute gets kind of phased down up to that income limit. Whereas in a 401k Roth feature, we don't even look at income limits of that individual participant, but again, right now, the technical downside is if that Roth money is in a 401k plan, when that person hits, right, the required minimum distribution age of 72, you still have to take required minimums on that. And there's strategies to get around that, but bottom line is this would kind of eliminate that complexity. All right, so we're going to go a little bit further here. So on this slide, next couple of slides, by the way, I've got kind of the summary of what's in the RISE Act, or the Rise and Shine Act. I know I previously did a webinar on Secure 2.0, a couple of webinars, as a matter of fact. So right here, we're going to go over the Rise and Shine. And again, this was the ones in blue. Let's talk about those, right? Updating a dollar limit for mandatory distributions. This would take the $5,000 cash out to up to a $7,000 level. Section 103, performance benchmarks for asset allocation funds, target date funds, that sort of thing. There would be a new method to, instead of just comparing performance returns to an S&P 500, an all equity index, you'd be able to do a blended index, which to me would make reporting and comparatives much more realistic, put it that way. It would eliminate unnecessary requirements for unenrolled participants, and it would improve coverage for part-time workers. That's the long-term part-time thing that I've talked about numerous times. It would essentially change that rule from a 2-year rule, from a 3-year period of time to a 2-year period of time. Consolidation of DC plan notices. Wow, 302, right? A huge win there for any adopting employer. It would also provide for auto re-enrollment under qualified automatic contribution arrangements, which would be good. And as I mentioned before, this one also covers those incidental expenses that I mentioned earlier. I'm going to go pretty fast through these things, and I'm only really going to speak, plan amendments for this stuff. And that's probably my concluding point for today. If this gets signed into law at any point, right now the proposal is to require amendments to the plan to account for this stuff by the end of 2024. So it would certainly give a period of time to enable adopting employers to get on the stick and get the plans amended and make it all happen. So with that, Beth, I don't know, we may have a minute left here. I don't know if there are any questions that came up.
We do have a couple of questions. Before I read it to you, I just want to remind everybody in the audience, if you want a copy of today's presentation, please download it from the handout section. All right, here's a question. Given that inflation is running high, what do you foresee with respect to increased IRS limits next year?
Oh, that's an interesting question. Not really part of what we talked about today, right? Because what we talked about today is a couple of pending bills that are out there. But, in roughly October or November of each year, the IRS normally announces new limits for next year. And, I don't recall the exact inflation figures, but, this stuff is all based upon CPI increases. And I think like last year, we ran 8.9% inflation. And the way the increase in limits works is they like to do them in round numbers for the last bunch of years, right? So if inflation goes or the CPI goes at a certain level, if it goes above that next threshold of an even number, you'll see an increase. So again, really with, call it 9% inflation for the last 18 months, the $20,500 deferral limit, I would anticipate that going up to $22,000 is where I would see that. That would be probably the biggest increase I've seen in my lifetime in that limitation. Catch-up limits also increase in roughly $500 limits, or I should say exactly $500 limits. So the current $6,500 catch-up is, by my estimation, would go up to about $7,500. And I guess the other one I'll hit, I'm not going to go through all of what I was thinking on this, but the current salary limit for a qualified plan is $305,000. That's likely to go up to about 335,000. So there'd be a almost, not quite a 10% jump in that number is what I would anticipate. So, Beth, are we over time, or do we have time for one more?
We have to. Let's just ask this one last one. If legislation is passed before the end of 2022, what is your opinion on when the bills will go into effect?
Yeah, really good question. Some of the way these, I'll try to make this quick because I think we're at time here. Some of these bills, again, as I said, started back in 2021, maybe even a bit earlier, right? And some of the deadlines, right? A good example is the deadline to implement the long-term part-time eligibility, which was a 3-year rule in Secure Act. This would make, I guess it was going to try to make that a 2-year rule. In theory, that would have been effective if this had passed, last December. It would have been effective in 2023. I have two things. I have a hunch we're going to get some action on this legislative front this year. That's number one. The second thing is when. Pension law, retirement plan law normally is not a standalone piece of legislation. My guess is this is probably going to get attached to a spending bill. So that means November or December, right? So if this stuff gets into law in November or December, Secure Act was passed in, I think, December of 2019, right? I don't see how retirement plan providers are going to be able to implement effective things that were effective in 2023 within a week or 2 or 3, right? So I think the deadlines, the implementation effective dates on some of this stuff will get pushed out is the answer. I think it'll get pushed out. Some of the things that would have been effective in 2023. Now, some of the other things that are easier to maybe handle, by the way, some of the other things we didn't even talk about today, they're looking at enhanced catch-up contributions. One bill has it at age 62, 3 and 4 kind of graded up. The other bill just jumps it right up by 10 grand. So some of the things might be easier to do, but I think they'll give flexibility and push some of the tougher ones out a little bit, Beth. Thank you.
All right. Thanks, everyone.
All right. Thanks for joining, everybody.
Have a great day.